Hello, everyone, and welcome to this week's educational class, where today I want to talk to you about the 4 steps to trading consistency. These are 4 great steps that I truly believe will increase your odds for consistency. And by the end of today's class, you'll know how to apply them exactly to whatever method you're currently trading. Now, I'd like you to take a look here before we begin at this older chart of Adobe here and get used to this chart because we're going to be looking at it a lot today for educational purposes. Now, one of the problems most traders have is to figure out what exactly the market wants to do. Which direction does it want to go? For example, are we going to go sideways? Are we going to go up? Well, someone might say, well, in all actuality, if we just follow basic fundamental analysis or technical analysis, I should say, we're in a downtrend because we're making lower highs and lower lows. So we should be looking to short this, right? Well, with the first step that I'll be teaching you today, you would have known that we weren't in a downtrend at all. In fact, we were actually in an uptrend. And then the second step would have told you whether to buy or to sell. And you could have chosen right here as a unique buy area of your choice. You would have known on the third step where to place your stop. And the fourth step would have told you where to exit, which would have been right here. So had you taken this trade based on the information we're going to teach you today, you could have potentially captured 22.5 points. So this is what we're going to be talking about today. The 4 steps that will actually increase and give you a great guide to trading consistency. Now, everything you're seeing today will be displayed coming from the platform I developed with proprietary strategies. That's the PTS Primo charting platform, the educational platform that actually teaches traders how to trade. So welcome once again. My name is Stephen Primo, president and founder of Specialist Trading. If you're new to my educational classes, we are all about one thing, and that is simply educating you. We are first and foremost an educational company. So we're a little bit different from other webinars you may have attended in the past, in that I'm not going to tell you today what I think the market's going to do. Is it going to go higher? Has it topped out? What the perfect time frame to trade is, or the perfect stock or market to trade is. Those are all things that you have to decide. You see, I've been trading now for 49 years. And if there's one thing I've learned in my 49 years of trading is that the only traders that are still around are the ones that make their own trading decisions. So I started my career out on the floor of the stock exchange. I was on the floor for 16 years, and now those years I was a specialist. That's where we get the name specialist trading. And while I was trading on the floor, I learned a ton of different techniques, tips, and methods. And what we do with specialist trading is teach all of our students all of these things that I've accumulated in those nearly 5 decades that have high levels of consistency, with the goal of having you make your own trading decisions. We want each and every one of you not to just have a couple of few good months, but a couple of maybe good decades of trading in front of you. So that's our goal, to actually teach traders how to trade. You'll see that in today's educational class. Now, before we begin, we are required to share this with you, so please take a moment to view our disclaimer. I'm going to share with you a lot of performance results by using these 4 steps, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. And as I said earlier, since we are an educational company, first and foremost, all examples are strictly for educational purposes only. Now, I see a lot of new faces in today's class. Actually, I see your names. I don't see your faces, but a lot of new names here. So if you'd like to get more education on a daily basis, different ways to follow us. Firstly, you can follow us on X, formerly known as Twitter. There's our handle right there. If you haven't done so already, please feel free to follow us on X. My handle is at SPCLST, TRADG, abbreviation for specialist trading. Every day, if you go there, you'll see I've already posted about 5 or 6 different snapshots today. I usually do that on a daily basis of different signals that our strategies have generated, also little bits of financial wisdom. So there's lots of great free education on X. Also, we are broadcasting this live now on YouTube. So this is streaming live. If you'd like to get more of this content, hit the subscribe button at YouTube and you'll see a lot more of this content coming live, okay? So different ways in which to follow us. All right, with that stated, let's begin today's educational class. I want to start out with something that my mentors taught me, because remember, I started out on the floor of the stock exchange. And even though I had access at that time to, privy to information that really the public didn't know about yet, because we had advanced news forms at that time, or I had high-speed computers that really weren't available to the public yet. At that time, they were high-speed computers. Even though I had these advantages, I still struggled tremendously my first year. And I did the exact same things that I've been taught, that most of you have been taught, but it wasn't working. And the reason why, there's no consistency in those things. But here's the main thing that my mentors taught me. They said, Steve, trading is really simple. It's the trader who makes it more difficult than it has to be. Okay? So think of it. Are you looking at multiple markets, too many time frames, too many different variables in which to trade? Do you have 5 or 6 different systems working or strategies running at the same time? Different time frames going on at the same time? Do you have multiple phones or TVs in front of you watching different news events or different information to help you make decisions? This is a classic example of overcomplicating your trading. I know this because this is the way I used to trade. Even though I was on the floor, I was following every trading guru. We didn't have chat rooms or trading rooms then or blogs, but we had newsletters. I was following 10 or 20 of them. I had maybe about 30 indicators on my charts, and I was looking at all the fundamental news, waiting to make a decision based off of. And my mentors, who were specialists themselves, saw that I was really overcomplicating things. And they said, remember, it's really simple. In fact, it's the traders that have a simple, easy plan to follow that have the longevity, not the ones that overcomplicate things. So take a good hard look at your trading. You have far too many things going on, far too many markets, far too many things to listen to or try and follow. That is a classic example of overcomplicating your trading. I know this once again from firsthand experience. So really, trading is simple. It's the trader who makes it more difficult than it really has to be. So with that stated, in order to be consistent, you must always apply these 4 steps. And it makes no difference what strategy you trade. It could be one of ours, could be something you've developed or from another educator. It makes absolutely no difference. It makes no difference what market you trade. It could be crypto, could be currency pairs, could be stocks. And it makes no difference what time frame or what direction. It could be a tick chart or it could be a monthly chart. If you add these 4 steps, I really, truly believe that it will increase your odds for consistency tremendously. Okay, so let's start out with obviously step number 1, and that is, am I on the right side of the market? Simple enough, right? But think about it. Everyone going into a trade thinks they're on the right side of the market, right? So why is it estimated that upwards of 80 to 85% of all traders fail? Well, basically, you're on the wrong side of the market. You only lose when you're out of sync with what the market wants to do. So obviously you're not on the right side. So let's go back to our old friend Adobe here, all right? Once again, we can look at this chart and not have any idea of what it wants to do. Maybe we'll avoid it entirely. But here's what my mentors taught me, and the first thing I teach all of my new students around the world, regardless if they've been trading 30 years or maybe just 30 minutes. And the first thing is to ask themselves a question, and that is, apply the 50-period simple moving average and then ask yourself, where is price in relation to the 50-period moving average? Okay, so the first thing you have to do, regardless of market, time frame, just apply the 50-period simple moving average on whatever chart you have, and then ask yourself, where is price in relation to that 50-period simple moving average? Because you'll only really come up with 2 possible scenarios. If price is below, well, then the market is telling you that it wants to go lower because the overall trend is down. But in this case, as you see, price is above. So what is the market telling you? Not some guy on TV, not some economic report, or not some earnings report, or not some guru, but what is the market telling you? It's telling you the overall trend is up, therefore I want to go higher. So in order to be on the right side of the market, you want to want what the market wants. So therefore, in this scenario, the market wants to go higher, so you want to be a buyer. It's as simple as that. And if you don't believe me how powerful this first step is, go back and look at your last 10 or 20 trades, and then apply the 50-period moving average and ask yourself, did I buy below the 50 or did I sell, meaning go short above the 50? I can almost guarantee you the reason why you had losses is because you were out of sync with this simple but powerful rule. It doesn't cost anything. I mean, all of you should have access to the 50-period simple moving average. So we know, just looking at this chart, that the overall trend is up, so we want to be a buyer. Now, let's say you're a student of candlesticks, okay? All right, so let's say you see a bullish engulfing pattern right here. So you want to be a buyer then based off this. And let's say you decide to buy once we trade above the high of this second bar in the candlestick pattern. Okay, now there's no guarantee this is going to work, but we're trying to put the odds in your favor. And if you only go long when price is above the 50, you will have a greater level of consistency than going long when it's below. This now leads us to step number 2, which is, where do I place my initial stop? Now, most beginning students say, wait a minute, shouldn't I be thinking about where do I get out with a profit? No, that's once again an incorrect way to think. You have to always think prior to, if you're going to have a winning trade, what if you have a losing trade? And where am I going to get out? I can't tell you the number of new students I have who have no idea where to place a protective stop. They say to themselves, well, I'll figure that out as the trade goes along. I just want to see how it works out, and then I'll kind of come up with an idea of where I want to get out. Usually it's too late, and then you turn into a long-term investor, right? So we want to know where to place our initial stop, our protective stop, meaning where are we going to get out if we're wrong. Now, in our courses, we have upwards of 6 or 7 stops that we teach our students. Remember, we're an educational company, so our job is to provide you with all these different variables so that you can choose which feels better for you. Some students like to take high risk, some students like to take low risk. So let's just use a very simple benchmark stop placement, and this is what's called the most recent pivot low. All right. So if we're going to be buying here, what we want to do is go back in time and see where was the most recent pivot low. Now, a pivot low, if we're going long, looks like this kind of a V shape. We have a 3-bar pattern. The first bar makes a low, the second bar makes a lower low, and the third bar here makes a higher low. So you create this kind of a V approach. That's where we would place our stop, just a little bit below that. Okay. It's entirely up to you how much you want to, be below it, but that's where you should place your stop. So we're going to be entering right here, and if we're wrong, we'll get out right here. This leads us now to step number 3. Now we can determine where we want to get out with a profit. We ask ourselves, what is my profit target? And in this scenario, the reason why is because our stop placement is going to determine where we get out with a profit. Let me share with you what I mean here. If we were to enter right here and say the minute we bought it, it went south and we lost money, how many points would we lose? Not how many dollars, because everyone's going to invest a different amount. How many points would we lose? In this case, if we measure the distance from entering here to getting stopped out here, it would roughly be 11.25 points. Okay, so what you want to do is have a good risk-reward ratio. Technical analysis 101, trading 101. This means you want to make at least twice what you're risking. So if you're risking 11.25 points, obviously you want to at least make 22.5 points. All right, now you can make more than that, but in this simple scenario, we're just going to go for making twice that much. If you do this on a consistent basis, you'll be a more profitable trader because you'll be making twice what your losses are. Okay, so we want to make 22.5 points. So what we do is add that number from our entry point. All right, 22.5 points, and this gives us our exit level. And now we'll place a limit order to sell at 247. So we know where we're entering, we know where we're placing our stop if we're wrong, and we know where we're exiting if we're right. Now, all of this is done and should be done prior to even entering into the trade. This is what professional trading is about. These are the way professional traders trade. They know where they're getting out if they're wrong. They know where they're getting out if they're right. They know where they're entering even before they are in the trade. That's the way professional traders trade. This brings us to our 4th and final step, which in my opinion is the most important, and that is, how do I protect my profits? Now, I can venture to say, through past experience, and I'm sure many of you have gone through this yourself, the worst feeling in the world is to know that at one point in time, on paper, you had a really nice profit, a paper profit, but you stayed in the trade too long or something happened, and then all of a sudden, that profit dwindled away, and now you have a loss. That is the worst feeling in the world. In fact, traders would rather know that the minute they got into a trade, it just went against them, and they, took it as a loss and say, well, I was just wrong right off the bat. But the worst feeling is to know that you were right for a while, but then you didn't do anything about it and it turned into a loss, okay? So how do we protect our profits. This is what's called protecting your profits. And we do this by applying what we call our 50% rule. Okay, so what we want to do is measure the distance from where we'd enter to where we'd exit. Remember, we haven't even gotten into the trade yet. And this is what we call our 50% level. This is half the distance to our profit point. So the way this works is once price, if it does go in our direction, if it gets around this area, it doesn't have to trade exactly at this number. It's not a magic number, but if it gets somewhere close to here, below or above or on, we can now move the stop, cancel the stop, and move it to unchanged. This way, if it gets up to halfway to our point of where we want to get out, and then all of a sudden it turns around and goes south, at least we didn't lose anything. So we're playing with what we call the house's money. We don't have anything to lose. Okay. So what a lot of students like to do is maybe take half of their profits or a portion of their profits here and then move their stop up. So at least they have some type of profit. There are a number of ways in which to apply this, but we're just going to tell you that the most basic way is to move your stop to unchanged at this point. So let's watch the trade unfold. So far, we have not entered into the trade yet, except we know all these different variables. We're trading like a professional because we know exactly where all our points are. And now we entered into the trade. We're long at 224.5, and we're just watching. And ultimately, we got to that 50% level. So what do we do at this point? We cancel this stop because we don't want it to stay there, because if it goes down, now we had a nice profit that turned into a loss. So we're going to move this to where we bought it by changing the stop placement and moving it to the entry price. Once again, we're playing with house money now. We have nothing to lose. Now, this is what we say true trading is, because the only thing left to do is to watch the trade unfold. As I've stated often, and what I personally feel in my own personal trading, if you're trading correctly, trading is really boring. So that's how you know you're trading correctly, because it's very similar to fishing. Whereas you just go out in the boat, whether you're in the ocean or on a lake, you cast your line and you just wait. That's the way you fish. Well, trading is the same way. There's no reason to be having two phones in two different hands, yelling and screaming. There's no reason to have 3 or 4 screens in front of you, or 4 TVs in front of you all in use. If you're doing that, you're more likely gambling than actually trading. Because true traders know that trading is really boring, because that's how trading should be. You have all your variables in place and you just wait. There's a lot of waiting going on. So we have everything in place. All we have to do is wait. We're either going to exit with a profit or we're going to exit unchanged. We don't have anything to lose now. So let's see how the trade unfolded. It's going in our direction, but kind of just hovering around that 50% level, starting to veer up a little bit. And ultimately, it got to our exit point. So we had a nice 22.5 point gain. All right. Now you see, if you notice, none of this was based on any economic indicators, any economic announcement about interest rates or what's going on with the economy. Nothing was based on an earnings estimate of the company. Nothing was based on what some guy was talking about in a trade room or what some guy was blogging about the inner workings of the company. It was all based on the chart in front of you. Think of it. This is the source of what you're trading, the chart. So shouldn't this be what you're listening to? But for some reason, we are trained to look and to listen to outside sources, what some guy's saying on TV after the close, what someone says online or in a blog, or what some interest rate economic prediction is. It doesn't matter. Just listen to the chart in front of you, and you'll be that much more consistent. All right, let's look at another example so you really get these 4 steps under your belt here. Let's say we're looking at FSLR, once again, an old chart just for educational purposes. And let's say you're a technician now, okay? And you follow all technical analysis. And this is a perfect textbook example of a bullish wedge, a very bullish pattern. Because if price closes above this wedge, usually what happens is price goes all the way, at least to the recent high, and most likely above. So you're all excited. You can't wait to see what happens. And on the very next day, what happens? It closes above. So right there and then you jump in and say, I'm going to be a buyer. This is perfect technical analysis 101. I want to make so much money. I can't wait. And this is a perfect example of why most traders fail, because you're not applying these 4 steps. What's the first step? Step number 1, ask yourself, am I on the right side of the market? Now, looking at this example, this student would have said, sure, I'm on the right side of the market, Steve. It broke out of that bullish wedge. But remember, that's not the way we determine whether you're on the right side of the market. The way we determine it is by applying, regardless of market or time frame, you must always apply the 50-period moving average. And now you ask yourself, where is price in relation to the 50-period moving average? Now, earlier it was above. You had 1, 2, 3, 4, 5, 6 bars closing above, but then we started closing below. 1, 2, 3, 4, 5, 6, 7 closes below. More than enough for the market to tell us, not me, not some guy on TV, not some economic report. The market is telling us, I want to go lower. The overall trend is down. So we want to be in sync with the market. We want what the market wants. So if the market wants to go lower, we do not want to be a buyer. Why? Because the odds are against us that this is going to work out. Now, will it work out every once in a while, a buy signal below the 50-period moving average? Sure. Just like the slot machines in Las Vegas. Every once in a while, you'll get a nice winner. You'll see the bells and whistles go off and you'll win a little money and you'll think, hey, this is great. But that's a false sense of security, because if you stay there over time and you continue to put your money into the slot machine, you'll give it all back. It's the same way with buying below the 50 and going short above the 50. Now, obviously, you can sell, meaning you can exit a trade wherever you'd like. But when we say sell above the 50, we mean more advanced, going short, betting that the market is going to go lower, okay? So we decided not to buy here, knowing that this goes against step number 1. And that was a good idea, because look what happened. In the next 2 days, we most likely would have been stopped out, or if we stayed in the trade, we'd have a nice loss on our hands, okay? All right, so let's say as a student, you didn't take this trade. You said, wow, I dodged a bullet right there. But you still want to trade. You're still a student of technical analysis. Nothing wrong with that. And so you say to yourself, okay, so since the market is telling me it wants to go lower, then I want to look for some type of setup that's going to short the market, that's going to bet that it goes lower. And what do you see here? You see a little support or some type of ledge, and you say to yourself, okay, if it breaks that support, if it closes below or trades below, I'm going to sell or go short, maybe buy some puts. Okay, that's a feasible plan. That's fine. You're in sync with step number 1. There's nothing wrong with that. Now, is there a guarantee that that's going to work? No, but at least now you have the odds in your favor. You see, trading is a numbers game. It's not about every trade being a winner. I've been trading for 50 years now, nearly, and not every trade I have is a winner, okay? I started out today trading E-mini futures on an intraday basis, and my first 2 trades were winners, but the next 2 trades were losses, so I stopped, and I broke even on so far on today. And that's just the way trading goes. But let's say you decided to go short here, all right? All right, so now we go to step number 2, which is, where do I place my initial stop? Remember, we are going to be focusing on, firstly, if we're wrong, not if we're going to make money. So let's just, once again, instead of going through all the 6 or 7 different stop variables that we offer our students, let's just use the same one we did before, the very benchmark pivot high. Okay, this means that if we were to enter it here, let's go back in time. Where was the most recent high? And that pivot high would be right here. Okay, now pivot high is the reverse, meaning that it's shaped kind of like an arrow. You have 3-bar pattern. The first bar makes a high, the second bar makes the higher high, and the third bar makes a lower lie. So you kind of create this kind of a arrowhead approach. So this would be our stop placement, just a little bit above that, okay? All right, this leads us now to step 3. Now we can decide where we're going to get out with a profit. Where is my profit target? And once again, in this example, this is determined by where we place our stop. So if we were to enter at this point here, and let's say all of a sudden the market did decide to go up, how much would we lose in terms of points? Not in terms of dollars, but how much in terms of points? And in this case, it would be 8.20 points. Now, if this meets our capital size requirement, we can afford to risk 8.20 points, great, then we want to make twice our risk. This is our risk-reward ratio. We can make more than that, but let's just stick with the standard making twice what we're risking. So if we're risking 8.2, we want to double that, and that means we want to make at least 16.40. So using that number, we will subtract that from our entry point. If we were to enter, we subtract 16.40, and that gives us our exit where we'll cover our short right here at 51.15. So once again, we've all done this and taken care of this prior to even getting to the trade. We know where we're entering to go short. We know where we're exiting if we're wrong, our stop placement, and we know where we're exiting if we are right. So we're trading like a professional now. This brings us to the fourth and final question. How do I protect my profits? The most important question, in my opinion, because remember, we don't want to be in a great trade that's on paper, giving us a nice paper profit, and stay in too long and then have that turn out to a loss. It's a terrible feeling because you could taste it, you could feel that profit, and you think, wow, just a couple more days and I'll get out with a 16.40 point gain, and then all of a sudden it turns into a loss. So we want to protect that. So we use what we call our 50% rule. If we were to enter and go short right here, and we were to exit with a profit right here, what is the halfway distance mark? Well, it's right here, 50%. So this means that if price gets roughly around this vicinity, it doesn't have to exactly trade it. Once again, it's not a magic number, but if it gets somewhere around here, we can cancel the stop placement and move it to unchanged. So let's see how this worked out. Well, it's going in our direction. We got short. Wow, now it's really going in our direction. And obviously it hit the halfway mark. So now we want to cancel this stop placement and we want to move the stop to where we entered. This way, once again, we're playing with the house money. We have nothing to lose. We're either going to break even if it turns around and goes up, or we're going to exit with a profit. So as we said, if you're trading like a professional, it's very boring. It's like fishing because the only thing left to do is simply to watch the trade unfold. No reason to be nervous or intense or upset about what's going on. You're just sitting back and waiting. As we watch the trade unfold in 1, 2, 3, 4 days, we get down to that level with a 16.40 point gain. There you have it. These are the 4 steps to trading consistency. You should be able to apply them now to any method you're trading. We're not going to tell you that you can only apply these to our methods and you have to spend $5,000 or $10,000 in order to be a consistent trader. No, we don't believe in that. We're an educational company, and everything we teach can be applied to other markets, other methods, other systems, because we want you to become a consistent trader. Now, what if I could offer you a ton more, let's say a dozen more different edges and tips and techniques, just like the ones I shared with you today? Would you be happy with a program or some type of course that offered that? Well, I think you would, because look at this. We can also apply this to different markets. Here's a 1-hour chart of the British pound. Same thing applies. We had a buy signal using one of our strategies right here. Got up to the 50% level. We moved our stop up and ultimately exited with a nice 95 pip gain in roughly less than a day. That's $950 on balance that you potentially could have made. Here's another example, SMCI, okay, a buy setup right here. You could have entered. Here's the halfway mark, move your stop up and exited with a 6-point gain in less than a week. Or an older chart of NVIDIA, a buy signal was generated right here. We placed our stop just below the most recent low. At the halfway point, we moved our stop up, and in a couple of weeks, we made 14 points, all using the same things. And lastly, here's an example in ABNB, an older example. Buy signal right here, and look what happened. It gapped up right to our exit point. So we exited right here on the opening with a nice 17-point gain in just a couple of days, and then right back down. All of these examples using what I taught you today. So we have a great special offer for all of you taking time to watch this educational presentation today. As I stated earlier, I'm sure you would like many more tips and techniques. Well, we're going to offer you our Trading Floor Edges course. What this is a 10-video course which includes over 49 years of trading experience. That's how long I've been trading now. I can't believe it. 49 years of all the things I've accumulated, and most of these things you won't find anywhere else because they're what I've accumulated from my years on the trading floor. 2 techniques that will elevate your trading that we haven't talked about today, how to be in sync with the overall trend. Now, we showed you one way. We have 3 more different ways to be in sync with the overall trend. 3 steps to a successful trade, how to fine-tune your entries, also next level exiting techniques. But here's what I think is the best thing about this course. It's what we call a superior candlestick trading edge. We know that a lot of you trade candlesticks. Either you're just starting to, or you've always traded candlesticks. So what we want to do is share with you what we feel is the correct way to trade candlesticks. In our opinion, the traditional way of trading candlesticks doesn't have a high level of consistency. For example, if we look at this older chart in Workday, WDAY, we see that we're in a nice uptrend, a classic uptrend of higher highs, higher lows. Now, the way most candlestick patterns work are as reversal patterns, meaning that they're looking for a reversal of that trend. So obviously, since we're in an uptrend, we're looking for a pattern that's telling us that this trend is about to end. And what do we have here? One of the most prominent candlestick patterns, a bearish engulfing pattern, a 2-bar pattern that signals most likely a reversal of trend. So this means that we've most likely topped out here and you should be selling. All right, so let's say you sold using this traditional candlestick pattern, and look what happened. See, this is what our students and we at Specialist Trading and Pro Trader Strategies have found, that traditional ways of using candlestick doesn't really have a lot of consistency. So here's what we would have told you. Using our non-traditional candlestick method, you would not have sold here at all. In fact, just bars before it, you would have gone long and potentially captured 35 points instead of a losing trade. So this is what we'll teach you in the course, a superior candlestick trading edge. This course is jam-packed, as I said, with information that you won't find anywhere else, because it's 49 years of tips and techniques that I've accumulated, mostly from my years on the trading floor. Now, this course is so popular as well as so important that we offer it on the Pro Trader Strategy site for close to $1,000. But here's what we're going to do. We're going to discount this tremendously, but only for a very short time. We're going to drop the price down to $19. Think of it. Nearly 5 decades of tips and techniques that I've accumulated for less than $20, $19 for yours to keep. But this is for a very limited time only. I think it's only going to last a day or two. So you have to take advantage of this. But we're going to take it a notch higher. We're going to also include an extra bonus, because if you decide to become a student of mine in the Floor Trading Edges course for $19, we'll, along with your purchase of that, we'll also include a 50% discount on any other product we sell. So let's say you purchase the course for $19 and you say, gosh, this is really amazing. This can really help me. And you're interested in one of our strategies or one of our indicators. We'll still include a 50% discount on any other product or course that we teach. This is a great way to take your trading to the next level. You owe it to yourself to take your trading to the next level. Start out 2026 in the right direction. I know many of you are struggling. I know many of you make all these hopes and promises and have all these dreams of where you want your trading to be by the end of the year. And most likely they didn't meet those dreams and requirements last year. Start it out in the right direction. Take your trading to the next level. You don't have to spend a lot of money. Less than $20. You can't even go out for breakfast for one person, I think, these days for less than $20. If you're going out with someone else, boy, it's going to cost you $35, $50. But for less than $20, $19, you can have nearly 5 decades of information at your fingertips. Here's how to take advantage of this great offer. Contact my sister site, Pro Trader Strategies. I would highly recommend giving them a call at area code 310-598-6677. They have trading consultants that would be happy to answer any question you have or take your order over the phone. Remember, this is for a limited time only. And they'd be happy to answer any question you may have about maybe that 50% discount or what else is offered in the course. Okay, now, as you see in the very bottom, that is a link that will take you to the info page. Also, if you'd like to sign up online, you can take advantage of that link as well, but it's not a live link. So what we've done is in the chat box, if you click on that little chat icon in the Zoom tray there, you'll see that they have posted a live link there. You can just click that on and it will open up a browser and you'll be able to see more information about this course, okay? I'm going to leave this information up here. We have a few minutes left. If you have any questions concerning what I went over today, if you something that makes sense, or if you just want to ask something or just to clarify, go to your chat little icon right now, or a question and answer icon. Type them in, and I promise I'll answer them to the best of my ability. Someone's asking, are your methods a black box method? No, these methods, we teach you exactly what's in them. For example, today I taught you the 4 steps. They weren't a black box method at all. You know exactly what they are. Now, some of our indicators are black box not because we're trying to hide or keep it secretive, but because it's so complicated and they're very cumbersome. We don't want to burden you with having to sit there for 15, 20 minutes with each tick to figure out what's going on with the indicator. So we've turned it into a black box so that you don't have to really worry about it. So that's a lot easier. But I would say a good 90% of all of our methods are just simply there for you to understand. Someone's asking, how about scanners? Yes, we have all of our courses and indicators have scanners. So you can scan for all of these for the next day. For example, the step 1, which is the finding out if you are on the right side of the market. You can have that scan on the platform, and with one click, you will see, you can pick the market, you can pick whatever market you like, crypto, you can pick the Dow Jones, S&P 500, NASDAQ. You can create your own basket list of stocks or markets and see in less than a minute which stocks are over the 50-period moving average and which ones are below. And it's a great scanning process, extremely simple. So yeah, scanners are available as well, okay? Someone's asking, do these strategies and techniques perform well in different market conditions? Yes, one of the best things about all of our methods is that you can transfer them to any market, any time frame, in any direction. Now, a lot of our students have told us in the past that they purchased a method, but it was only good for one particular market and maybe on looking only at daily bar charts. But they also traded intraday charts in a different market, and the technique or method didn't work. Well, we don't subscribe to that. We feel that if something works on a daily time frame in one market, it should be able to easily be transferred into another market into another time frame. And so that's all of our markets are easily transferable onto different markets and different conditions. Now, the one thing I do have to say, because this is just something, this is just stands to reason, when markets are choppy, usually this happens in the middle of summer from end of July to August, when everyone takes off and usually nothing's happening in the markets and they just kind of go sideways. Well, every strategy, it makes no difference, or any method, any system has a difficult time. But I'm happy to say that a lot of our techniques are really good at keeping you out of these conditions. Not guaranteed, but they will. You'll have to suffer less than some other courses from other educators. So that's one of the best things. Even though it's difficult trading in those sideways markets, a lot of our methods are geared to keep you out of those markets. Okay. Good questions. Any more? One more. Are there any subscription fees or data platform fees if I decide to become a member of your Pro Trader Strategies platform? Oh, no. Well, yes. I mean, there is a cost for that. You will be able to get that at half off, I believe. You have to talk to Pro Trader Strategies. But after that, no, everything is included and for the remainder of the subscription. If you get a yearly subscription or 5 years, it's up to you. But there's not any hidden cost. In other words, everything is upfront, and you'll know exactly how much you're spending per month or altogether if you like to buy one time. Now, the one thing I would recommend is contact Pro Trader Strategies. They're very flexible. They're there to work with you. They'll be happy to talk about discounts and payment plans. But right now, I don't think you'll need a payment plan for just this initial discount of $19 is really a great deal. It's a great way to become acquainted with what we're trying to teach you. Now, remember, it's for a limited time only. I believe it's only for a day or two. So if you want to take advantage of this, we're going to be sending each and every one of you a link to this recording so you can watch it again at your own leisure. But this is not the type of thing where you watch this for a couple of weeks and then you say, okay, you know what, I'm convinced. I'll call them back and get that $19 offer, because most likely it's going back to close to $1,000. So take advantage of it right now. I'm sure most of you can spend $19. Most of you may have spent that already on commission costs this past week. So $19, you're going to get nearly 5 decades of experience, tips and techniques that have taken me that long to accumulate, and they're yours to keep forever. Okay. All right, we're at the end of today's presentation. As we close and take one last look at our disclaimer, I just want to say thank you so much for attending. I really hope you learned something about how to apply these 4 steps and how they can really make you a consistent trader. But most especially, I hope you see that our attention to really trying to educate you. That's really our goal. We are first and foremost an educational company, and that's really our intent, to educate you as traders, because there's more than enough profits on a daily basis for everyone to go around. So why not share with you what has helped us and made us consistent traders? As we close, I just want to say thank you so much. And most especially, I look forward to seeing you in class. Thanks for attending. I hope to see you next time. Bye-bye.